Welcome to yet another lecture series on advanced audit and assurance. The last time we met, we were discussing the audit approach, right? And I said that audit approach is or can be defined as all the strategies that the auditor will deploy during a given audit engagement. That is audit strategy. And I also explained that there are four main strategies, right? Um, we have looked at the four of them. One is substantive testing audit approach, where I said that the auditor focuses on how to ensure that there are no material misstatements, okay, in the financial statement. And what that implies is that it's going to go all out, that it verifies and vouch every transaction. Well, that is the method that is deployed when you have adopted the substantive testing audit approach. Then we went on to looking at the statement of financial position audit approach, where I said that the auditor will focus on the information that is contained in statement of financial position as a strategy to understanding or to ensuring that there are no material misstatements in the financial statement. So it's going to ensure that it uses the information in the same financial position as a basis. And if he's doing that, then it's going to ensure that the financial statement assertions made by the management as per the financial statement presented is correct. So it's going to test those assertions via what? The statement of financial position. That is what we mean by the statement of financial position audit approach. The third approach is the approach that I call the business risk and risk-based approach, where the auditor will focus on the organization and try to understand what are the risks that affect the business, both internally and externally. The one internally is the one he can manage himself. The external one is the one that he needs to ensure he guides against the effects of those risks from affecting his business. Okay. And also in that business and risk-based approach, the auditor will focus on the key areas of the business. All right. And the style or the approach or the strategy the auditor will apply, the tools that the auditor will apply in this approach is known as what? Making use of what? Prospective financial information. Okay, because if you are using a business risk approach, business risk or risk-based approach, what you are trying to do is that you are not mainly focusing on what is happening now. Rather, you are focusing on what is going to happen in the future or how the future will impact your business, either negatively or negative or positively. So, as an auditor, you need to have that futuristic mindset. And the only information that can give you futuristic mindset about an organization is by looking at all those prospective financial information, ranging from the projected cash flow, projected working capital, okay, projected capital expenditure, projected recurrent expenditure, all those forecasts that you have made for the next 5 years. Like you see organizations now, they are projecting 5 years from now to see where the company will be in the next 5 years. If you want to take a loan from the bank, and the bank will ask for projected cash flow, okay? You will ask for projected cash flow for like 3 or 4 years or 5 years. You have to see the consistency in the generation of what revenue to be able to meet up with your repayment plan for the loans that the organization has collected. Okay, so those are the things that we discussed last week. Then I think also last week we also discussed the fourth one, which is the system-based or risk-based approach, where I explained that it's making use of what? The internal control system. And the tools you are going to use for this one is basically the test of control and test of detailed transaction. All of these were explained last week. And I also remember that we look at the types component of a good internal control system. And from there, we went on to looking at the types of internal control system, right? And that was where we stopped. Am I correct, or did we go further than that? Hello? Did we go further than that?
Correct.
All right, thank you. Then today we are going to take it further from there, right? We are going to talk about the use of internal control system by auditors, okay? Now, internal control system, like I said, it goes a long way in helping the auditor, right? It goes a long way in helping the auditor. So what are the things that it does to the auditor? How can the auditor benefit from using the internal control? One, it helps the auditor to identify potential misstatements, which is what I said. By the time we conduct the test of controls and test of the transaction, we will to know whether there is material misstatement in the financial statement. How will it do that? Now, if you look at the test of control and test of detailed transaction, both of them, right? You will agree with me that both of them, they are trying to assess the internal control system over financial reporting, which I call ICOFA, internal control over financial reporting. That is what these two tests are trying to do because it is established that if the internal control system is weak, it's going to affect the financial reporting. Okay, that is the understanding, and that is why when the author uses internal control system, it can use to assess the strength of the financial statement in terms of what whether it's accurate. Okay. Then number two use of internal control system by auditors is the fact that consider factors that affect the risk of material misstatement. So internal control also, if you look at the test of this transaction, especially in that particular test, you are going to request for documentary evidence of transactions, okay? You are going to request for documentary evidence of what transactions, and you are going to do what? You are going to vouch it in line with what? With the policy. Because organizations are supposed to have accounting policy, you are going to vouch it. So if there are situations where there are gaps in the internal control system, meaning that you have policies and those policies are not followed. For instance, you work in an organization and you said that you carry out you always depreciate your assets at so so and so rate, okay, using reducing balancing method or straight line method or some of digit method, but you don't have an asset register. How do you intend to do that? Do you understand? How do you intend to do that when you don't have an asset register or a fixed asset schedule? How do you intend to do that? Because it's only from that asset schedule you'll be able to determine or calculate what your depreciation will be. But we don't have an asset register and you have assets, okay, because you have not taken time to put in place a good or a verifiable fixed asset schedule, you cannot properly determine how much you are supposed to be providing for as what? Depreciation. Do you know what I'm saying? The third one is that by using internal control system, it helps the auditor to design timing and the extent of further audit procedures. So one thing will lead to another. The editor request for his particular document. I need this also and so information, documentary evidence is provided. From there, it's going to lead to another question. Okay. For instance, the auditor requested for the assets, what's it called, financial statement. He's looking at the state of financial position, and he saw that comparatively, looking at what they did last year and this year, he saw that there is a disposal of an asset has been removed from the asset schedule. And where this is, he saw this one in the what? In the statement of financial position. And from there, it leads to another question. What led to the disposal of this asset? Is there any documentary evidence? What was the reason? Is there any means of meeting? Is there board resolution that said that this asset will be disposed? All of this will lead to what? Further information. Later, we need to carry out further tests to be sure that, oh, these things are done in the proper or recognized way as stated in the IFRS, okay? So those are the ways that the author make use of what? Internal control system. Now, communication on internal control. Like I said, when there are weaknesses in the internal control system, when the internal control system is weak or they are weak, One of the letters that the auditor will write to the management is called management letter. I take it again. When there is a weak internal control system, the auditor will write a letter to the management highlighting the weaknesses in the internal control system. That letter is known as what? Letter of weakness. Or, you know what I'm saying? You call it letter of weakness or management letter. Either of the two names is what you can use. It's the same. It's the same. It has the same meaning. But you know, I always told my students that most of these audit terminologies they have more than one name. So as a student, you need to know all the possible other names of those audit terminologies because they can use them interchangeably. So you not be thinking that because if you do, for instance, they ask you an examination, what's the difference between letter of weakness and management letter? Some people will say, they will write a piece to not knowing that both of them they are the same. But if you don't have that understanding, you go and write giving the wrong answer. But both of them are the same. So either you call it management letter or letter of weakness. So this letter highlights principally the weaknesses the auditor observed during the audit of the financial statement of the client organization. Okay. So that letter, right, is usually communicated to the management and the board of directors, okay, so that they can strengthen the internal control system. Now, other information that is contained in that management letter, okay, is called approach and scope of audit. So in that documentation, the auditor will also explain the approach and scope of audit, okay, that's how he was able to arrive at those weaknesses, okay. Two, he's going to talk about selection of or changes in accounting system, if there's any change in accounting system, because all of these things is going to attach what? Documentary evidence. In audit, you don't say things verbally. You have to back it up with what? Documentary evidence. Three, audit adjustment that could have a material effect on the entity's financial statement. Okay? So for instance, you have this tax liability that you wanted to pay, but you have not paid. Okay? You understand what I'm saying? You have not paid, and you have to settle the tax liability to the relevant tax authority. Sometimes it can lead to adjustment. And also sometimes there could be changes in some of the accounting policies of the organization that will affect the way some of those transactions have been treated. For instance, maybe they did not recognize revenue as explained in IFRS 15. Okay, revenue with contract. They've not done it in that order. What they provided for as revenue is not so was did not fulfill all those obligation, okay, performance obligation. So if that is the instance, that could lead to audit adjustments, okay. Then material uncertainties that could cast doubt on the entity's ability to continue as a going concern business. For instance, if the company is highly geared, okay, or thinly capitalized, means that the company has more debt than equity, okay, that could have an effect on the working capital of the organization, okay. The company will not be able to have enough money to run their day-to-day operations, and that could cast doubt on the continuous survival of the organization. We have other instances. I want to be that has been explained under that's chapter 9, okay, where you're going to talk about evaluation and review. You're going to talk about that much later. So we have some other indicators of ongoing costs. Another one is when the organization is not able to pay its suppliers as at when due. Okay, supplier has given you credit days. He has given you credit terms that okay, you can pay after 60 days. 60 days lapse, you couldn't pay, you still elongated it. All of this will have an effect on the organization because you think that maybe the company is trying to close down. Or if there's a mass exit of management staff and these people are not replaced, okay, that could also be an indicator. So all of this information will be contained therein. The material weakness is internal control. I've emphasized more on that. Then questions regarding management integrity and fraud involving management. So sometimes you have management fraud, where the management are the ones that perpetrated fraud on the organization. Okay, so all of that will be contained in that management letter that will be shared with them. Now, what you need to also understand is that this letter is shared by the auditor at the end of the engagement. Okay, when it's done with the engagement, While he's presenting his draft audit report, he accompanies it with what? The management letter, which will be presented to the management. Okay, that is the process for that. Now, under no circumstance should the management share this information with third parties unless there's a need, there is a demand for it. There is an authorization that says that you have to give it out. You cannot share this information with the public. Okay, so the auditor has the power, the mandate to share this information with those charged with governance. Okay, those are people that he needs to share this information with. Under those circumstances, should this information be shared with third parties? Okay, and if peradventure it needs to be shared, they must seek consent of the auditor, external auditor, before you can share it. Okay, but I know that there are some sectors of the economy that some of this information you might need to share with them. For instance, we are working in a banking sector now, and the bank is having issues. I want to know that what happened to, I'm not there, but I'm just saying what happened to Heritage Bank. Maybe as a result of maybe the regulators got wind or had a copy of the management letter for the last audit that they did in 2020, 2023 thereabout. Maybe that was why they were able to take the action that they took. You understand what I'm saying? So some sectors, some of this information you cannot shy away from it. You have to share it with them. All right. So that is for the that one. The next one, internal control, as good as it is, right? Internal control, as good as it is, it has its own limitation. There are certain things that prevent, there are certain things that prevent the effectiveness of the good internal control system, and we are going to be looking at them one after the other now. Okay, so we have them in the first one is management override. Management will be the one that sets put controls in place, yet they will be the one violating those controls. So when the management set aside existing control that has been put in place, it is known as what? Management override. And this weakens the internal control system. Two, human error. Everybody is not perfect, right? We can make mistakes. And sometimes when we make some of these mistakes, it undermines the internal control system. Thirdly, we have substance over form. What substance over form means here is that at any point you are trying to implement control, you should always ensure that the control we are trying to put in place is beneficial, is more beneficial than the cost of what? The implementation itself. For instance, you are saying that you can use 1 million naira, if there is a fraud of 1 million naira, you can use 10 million naira to dictate it or to unravel it. Fine, it's good, it's a good deterrent, but sometimes it might not make economic sense, okay? It might not be professional, it might not be too good, okay, to be making such policies. Even though you are trying to say that you are trying to say that, oh, I'm trying to provide a deterrence for fraud, but we need to be able to balance it. That's what I'm trying to say. Being able to balance your cost, okay, with your expectation of that. Then we also have conflict of interest. Conflict of interest happens where there's a divided loyalty. That is, the staff has some form of interest or some form of relationship amongst themselves at the expense of the organization. Okay, that will lead to what? Conflict of interest, because sometimes you need to choose between their friendship and what? The love for the organization. Okay, that could result to what we call a conflict of interest, and that will undermine the internal control system. Then another one, failure to anticipate certain risk. That will also undermine internal control system. How will that affect internal control system? So what that implies is that when, like in Nigeria, we have had series of cases, snake swallowed money, ants ate up document, gorilla did all of this. All of these things were not envisaged before. All right? They were not what? They were not envisaged before. And because they were not envisaged before, when they happen, it undermines the internal control system. And lastly is collusion. Collusion is when people, staff, deliberately ensure to frustrate the effective running of an internal control system. They try to put control in place, but the staff decide to what? Deliberately frustrate the efficiency of such system that is being put in place. That's what we call collusion. And that is the greatest of them all that can happen in an organization. Because when this one happens, everybody will just decide to look away. Okay? And it will be very difficult to unravel the cause or the root cause of some of these things. Okay? So those are the things that, those are the limitations to the internal control system. Then we have mitigating controls also. So what that is saying is that you're looking at a form of an onion approach. If you look at onions, onion has different layers, okay? Before you get to the bulb, that small thing inside the onion, you have to peel several layers, right? Now, what we are saying here is that organization should endeavor to have that kind of onion approach towards their what? Towards their risk, towards their risk. They should be able to put different layers of control before their assets, before their resources, so that their resources will not be depleted or their resources will not become damaged. Okay, so that's what we mean by mitigating control. You have different layers of control. So, for instance, let me give an instance. So, let's say you're talking about attendance now. You're trying to ensure that people come to work on time. So, you have your biometrics attendance machine. Then you also have your what? Your register. Okay. There are days where the biometric machine will fail, right? When it fails, you resort to your what? To your register, uh, hard copy register or hard cover register. You know what I'm saying? So that's just a form of it. So we shouldn't say because it's a biometrics and when it fails, then everybody can now resume anytime they like. No, it shouldn't be like that. So that's a form of mitigating control you put in. You always have other ways where these controls complement one another. All right. So with that, we are done with chapter 6, audit approach. Any question? Any question? Any question? Any comment? Are we good? Okay. I want to believe that that means yes, right? So
Hello,
let's look
sir.
at yes. Any question? I'm with you.
Okay, good morning. Good morning, sir.
Morning. I'm with you.
Okay, please, can you please re-explain the management override and the substance overform?
Okay, thank you. Now, management
All right.
override, like I explained, it has to do with a situation whereby a control has been put in place, approved and put in place by management, is now deliberately what? Set aside by the same management that puts it in place. That is management override. So, for instance, the management says that for every transaction, for every money that must leave the organization, right, the head of account must sign off. There must be a document, a voucher that must be signed, approved before the cash is disbursed. Now, the CEO of the organization made incur some expenses on behalf of the organization. And he's saying that he wants his reimbursement now. He did not want them to go through the long process of what? Filling out the voucher, getting the approval. Since he's the CEO, he wants his money now. That is an instance of management override. Because the policies,
Okay.
if it to be a common man, or let's say a junior staff, they cannot allow that to happen. But for a senior person, it happens. That's what we mean by management override.
Okay, sir. So it's like them going against the rules that they have set.
Exactly. Exactly. Thank you.
Oh,
That's
okay.
management
All right.
override.
Thank you, sir.
Then substance, okay. Then substance over form is where you thought that, oh, you have put everything in place. You spend so much money to putting those things in place. At the end of the day, the efficiency, they are not getting it. So let me give an instance. So you put an ERP system in place in your organization. thinking that, oh, it's going to help to solve a whole lot of issues. But you now discover that the ERP that you have put in place, you spend so much on to implement in your organization, is not giving you enough value, the needed value. Because the essence of putting ERP in place to be able to track your transactions, to be able to see it at a glance, to be able to put controls in place, right? But you discover that those controls you are trying to put in place, they are not achieving the effect. And that's an example. Another instance is, we are saying that, oh, you want to guide against fraud. Let's do this, let's put in fire, let's do all of those things, costing over 100 million naira. What are we trying to safeguard against? Just 1 million naira. You are trying to safeguard 1 million naira with 100 million naira. That does not make sense. Okay. So what we are saying is that at every point in time, you're able to do what? Balance your cost with the benefit you are going to derive from anything that you are trying to do. That is the only way you can say that you have been able to provide or put in place a sound internal control system. Because if you do all of these things, for instance, now you put that you spend 100 million naira to put the controls in place, and yet you're able to steal the 1 million naira. What effect does that mean? That means that internal control system you have put in place has not achieved its aim. So that is it, madam.
Thank you for the clarifications.
Right. Any other question? Any other question? Any other question? We are good, right? Okay. Let's try and see if we can look at a question before we go to the next chapter. Okay, I'm coming. So this is a typical question on what we have discussed so far. Okay, on this chapter 6, audit approach. So let's take it together. This is question 7, November 2023. Okay, question 7, November 2023. It's been sent to you. You have a comprehensive Pathfinder. Okay, so you check it. So this is the question. The overseas technical partners of Orlando Professional Services came for a review of operations and system of internal control of the firm. A number of audit engagement files regarding financial statements on which the firm had expressed audit opinion were selected for review. It was believed that the strategic review will be necessary to determine the appropriate audit approach for a detailed audit plan in the firm to bring efficiency and enhance good client service delivery. The overview exercise also covers 1. The firm's basis for risk assessment on audit and assurance engagement. 2. Determination of staff recruitment, training, reward, and evaluation. 3. Previous audit opinion on financial statements and progress on ongoing jobs. 4. System of archival and retrieval of documents. 5. Major and other factors such as what industry issues. Okay. Next, external. 7. Reports from regulators. Now, the team interviewed partners, staff, and directors of major clients of the firm. It was believed that the outcome of the review exercise will help to reposition the firm and upscale strategies to get a fair share of the market in the upcoming mandatory rotation of auditors. At the end of the exercise, it was reported that the audit strategy of the firm was not robust enough, too generic, and lacked focus to meet firm's need in the next decade. The team recommended that proactive steps should be taken to evolve a good strategy that will stand the test of time in the light of the increasing competition in the audit and assurance marketplace. As a staff, of the firm, you have been selected as a member of the committee to develop the new audit strategy for submission in the next 2 weeks with the consideration for the consideration and approval of the Executive Council of Orlando Professional Services required. Outline the approaches to the main audit strategies your firm is expecting to adopt. 2. Explain factors that will be considered in the selection of the audit strategy. 3. Explain different the difference between audit strategy and audit plan? All right, that's the question. Have you seen it? This was 2023, November, question number 7. You can see that it's looking at what we just discussed. It's looking at it. Okay. So if you have a question like this, first of all, you need to have gained understanding, you need to have comprehended this question, this passage. You need to have looked at it wholly, because what they are saying here is that the audit firm, Orlando Professional Services, their audit strategy is not robust enough. And by this, it has a negative effect on their what? On their marketability. Okay. So what do they need to do? All right. And that is what is being asked here in this question. So we are going to talk about outline the approaches to the main audit strategy your firm is expecting to adopt. So, and if you look at what they said here, are we together? If you look at what they said here, they said that I want to show you one place here because you need to read with comprehension. Strategy review is necessary to determine the appropriate strategy for the flow. I'm coming. I'll show you now. What I'm looking for is where they said that big clients. That's what I want to check out. It's there. I read it now. Okay, this is one of it. Sorry. They are overseas technical partners. What that means is that these are we together? What that means is that this is like a big four, one of the big four. There's only the big four or the second tier audit firm that have overseas technical partners. The small medium audit firm will not have overseas technical partners because they are just small. But it's either a big four, one of the big four, or the second tier. The second tier example could be Panek and Foster, Bicatili, okay, Grant Thornton, okay. All of these are the ones that can be classified under this. So what that implies is that they are not a small audit firm. So that means their clients will usually be what? The big shot. Okay. So, and if you are dealing with big shots, big companies, they will like the most likely of all those strategies that we talked about, the approaches, they basically prefer basically two of them, right? Either they can use any of the four, but the one they will prefer to use mostly because the big organizations they always prefer the auditors to use what? Risk-based or business-based approach or system-based approach. Okay? Do you understand what I'm saying? But the other two, same financial position audit approach, society test audit approach can also be utilized. But most of those big organizations, they prefer either of these two, business risk or risk-based approach, one, or two, system-based approach. Okay? So those are the things we are going to focus on. Then that is the way to go about it. Okay? And I remember that we talked about all of this. The next one, explain the factors that could be considered in selection of the audit strategy. Okay, what are the factors? You need to look at the nature of the environment of the client. What kind of environment do they operate? Are they operating a computer-based environment or a manual-based environment? So everything is what? Just paper and documents. You need to look at that. Okay. You need to look at the materiality also, right? You need to understand the nature of their business. What are they into? That will also form a basis to knowing what we are supposed to do. All right. Then lastly, we are going to explain the difference between audit strategy and audit plan. That was the first thing I explained when we look at this topic. I said that there's a difference between audit strategy and an audit plan. All right. Audit plan is embedded in an audit strategy. So audit strategy is everything that you need to do about an audit, right? It's all encompassing. It contains all the planning decisions the auditor will carry out during an audit engagement. Why audit plan has to do with how the procedures, the steps the auditor will take to ensure that certain areas of the engagement are properly carried out or properly executed. That is the difference, okay? So we don't want to waste much time because our time is very limited. We look at but you have an understanding of what I'm trying to say. So let's go to the suggested solution. And like I said, suggested solution, you might try this thing on yourself. You might try out this question yourself. You might not be able to get most of the things that, or some of the things that have been provided or suggested. That's why it's called what is suggested solution. Okay. Under exam condition, some of the things that they put here, you might not be able to bring them forward because of the tension, okay, or the state of mind of the student as at that time. But if you are composed, right, let's say you are not writing exam, you are sitting down, you are lounging somewhere, then it will be easy for you to be able to do what? To be able to bring out some of these things, okay? So, but what I'm just saying is that when you attempt this Pathfinder and you didn't score more than, I mean, as expected, your performance was not as expected, do not be discouraged. You keep trying, okay? You keep trying. It's just to serve as a guide to give you an insight into how the examiner thinks or how the examiner relates or try to picture things. Okay, so that's what you need to know. So you just keep checking it. Practice makes perfect. Okay, so that is what I need to tell us, so that you will not be discouraged. It can be demoralizing when you check you attempted questions, and at the end of the day, the result or the answer does not correspond with what you have. It can be very, very demoralizing, but never lose hope. That's one of the things why you need. That's one of the things you need to learn. Okay. So that is for that. So let's do, we're almost there now. So look at it there. Look at them here. So we are there already. We are there. Look at it. The main audit strategy, you know what I said? Look at them. So the main audit strategies are as follows. Statement of financial position audit approach. You can see the audit approach concentrates on the statement of financial position using substantive testing on the argument that if the opening or closing statement or financial statement are accurate, then the profit and loss for the year must also be stated accurately. What did I say? You know, I said that there are some information that are contained in both statement of profit or loss and the statement of financial position that are related. Secondly, we have the second approach. We have the substantive testing audit approach, and this approach focuses on applying substantive testing on a large number of transactions and account balances according to the accounting system of the client. Okay, this focuses on recording transactions and balances means that understatement may not be detected. The auditor may ignore transactions that have not been what recorded. This approach is time-consuming and costly for the audit of large companies. This approach is appropriate when the system of internal controls are weak or not operating. Substantive testing on transactions and balances are therefore necessary to reach an opinion about the financial statement. It is widely used in the audit of smaller entities where controls are likely to be what? Weak. There is a danger in spending too much time auditing transactions in the balances that are not material. There is a risk of misstatement in the financial in financial transactions will not be detected unless all transactions and balances are tested, not just a sample. You know what I said about this is can see that it's very clear. The third one, approach, system-based approach. The audit focuses on the application of test of control on the system that produces the figure in financial statement on the rather than the figures themselves. Okay. The system-based approach is supported by some degree of substantive testing because of the unavailable limitations or weaknesses in internal control system. The amount of substantive testing required will depend on the auditor's judgment about the effectiveness of the internal control. How will they do that? When they carry out the test of control and test of detailed transaction, okay? It's also supported by the use of analytical procedures, okay? It is more cost-effective than a full substantive audit approach, but there is still a danger of doing too much unnecessary auditing for areas where controls are operating well. Okay, you can see the last one there. Sorry. Risk-based audit approach or risk-based or business audit approach, you can see an assessment is made of the likelihood of material misstatement existing in each area of the audit. Areas that are assessed as high risk are audited extensively using substantive testing, system-based analytical procedures. Areas assessed as low risk are given a low level of attention in the audit. This auditing method applied mainly to applied mainly by large audit practices focuses on business risk rather than overall audit risk. You remember I talked about that? Okay. Now the B part, the selection of the audit strategy will depend on a number of factors, including one, the size of the client business. Okay. A business risk approach is best suited for large companies, and a statement of financial position approach is suitable for small companies. The control procedures and control environment in place, a system-based approach is more suitable where there's a strong control environment and internal control system. Three, the audit method and technique favored by the audit firm. That's another reason. Okay. Four, the nature of the client business, you see it, the nature of the client business and sector in which the client plays a major role in selecting an audit strategy. Okay, a system-based approach will be more suitable for a client in the e-commerce sector than a financial position audit approach. Okay, these are the last one, the C part. Explanation of the differences between audit strategy and audit plan. Look at it. Audit strategy sets the scope, timing, direction of the audit that guides the development of the audit plan. It's similar to what I said, right? The audit plan is a more detailed than the overall audit strategy. Two. Three, planning and audit procedure takes place over the course of the audit as the audit activities of the engagement develops on events unfold. Okay? Audit plan from sorry. Audit plan is more detailed than the overall audit strategy. Because I said it, in the audit strategy, you just talk about the planning decision, but audit plan, you're going to look at every area. For instance, what's the audit plan for expenses? What's the audit plan for revenue? What's the audit plan for assets? What's the audit plan for receivables? Each of those classes, areas of your financial system, you're going to develop audit plan for them. That is why it is more detailed, okay? Then planning for audit procedure takes place over the course of the audit as the audit activities for the engagement develops or event unfold. Audit plan refers to the scheme formulated by the auditor that comprises of the strategies or approach that is followed for carrying out audits. You can see what I said. Okay, you can see that these things are not hard. But if you have not practiced, if you have not read, you'll be looking so gibberish or it will look so confusing. But because you have read, you have understood it, you can see the way we are flowing. I hope we are getting it. So that is for this, okay? Are we together? Any question?
Yeah, please, sir. I don't know if you
Yes.
can take the first approach. I think the statement of financial position approach again.
Were you in the last class when we started it? Or you just joined?
I was in the last class. I was there. No, I'm actually talking of this slide. Like this slide. You should just go back.
Okay, to this slide, okay.
Yes, just this slide. Yeah.
Where is it? I should explain it again, right?
Yes, sir.
Okay, what you have here is what I said earlier. It's an approach, right? Where, the financial statement is made up of, according to IFRS, is made up of the statement of financial position, statement of profit or loss, other comprehensive income, right? Statement of cash flow, statement of changes in equity, and note to the account, right? But in this particular approach, rather for them to use statement of profit or loss, they have decided to use what? Statement of financial position. Why? It is expected that the statement of financial position gives a more realistic performance about an organization. Okay? It gives a what? A more realistic performance about what? About the what? Organization. If you want to know whether an organization is performing, you can't see the true picture by looking at the statement of profit or loss. But by the time you look at the same financial position, you see how the assets have been what? How the asset has been utilized, which is very, very key. If the assets have been underutilized or overutilized, you see it there. If the company is highly geared, you see it there. If the company is undercapitalized, everything you're going to see it there. So it gives you an overall picture of how the organization is being operated. Then one thing again you need to note here is that there are some information that are contained in the same financial position that are also replicated in the statement of profit or loss under comprehensive income. And that's what we are talking about here. That is, the auditor will be able to compare those figures that they have taken from the statement of profit or loss and compare it with what statement of financial position to see whether they are what, whether they are accurate. And the only way you can do this is by using what we call substantive testing, because it needs to dig deep into those transactions. For instance, you need to dig deep into the inventory, because the closing inventory in your statement of profit or loss is your inventory in your statement of financial position under your current asset. So, and the value must be the same. The closing inventory in your statement of profit or loss and the inventory balance in your statement of financial position should be the same. How will you know that it's the same? By carrying out substantive testing, that is vouching and what? Verification. That is what we mean. Is that clear, sir?
Clear. Thanks. Thank you, sir.
All right. So we are done with this, right? So let's go on to where we stopped. We are done with that. The other question, question 6 of that same year, November 2023, is still on that audit approach. So please, guys, try them on your own, at your own spare time. You have the material already with you. Try them at your own spare time, okay? I hope it's cleared. So let's go on to chapter 7, audit planning. Ahead, you saw the difference between the audit strategy and audit plan. So there was no question in that. That means we are clear with that. So let's go on. So we are looking at audit planning now. Okay. Now, this chapter 7, audit planning, the audit plan is talking about what the auditor will do. So the audit plan is essentially focusing on the audit of what? Financial statements, okay? It's essentially focusing on what? Audit of what? Financial statements. So the overall objective of an independent auditor and in the conduct of the audit is in accordance with ISA, okay? That is the ISA 200 that talks about the audit plan, okay? And it says that the objective of every audit plan or of an audit is to ensure that the financial statements are prepared in line with applicable financial regulatory framework. That is one, okay? Then two, that the audit is performed effectively and efficiently. Okay, so those are the main reasons for the audit. Okay, those are the things that you carry out during the audit. Okay, so where the auditor is unable to obtain reasonable assurance and a qualified opinion is sufficient, then ISA 200 requires the auditor to do this. One, comply with all ISA relevant to the audit. Okay, ISA 200 says that you need to comply with all relevant information relevant to the audit. Two, comply with relevant ethical requirements. Those are the fundamental principles that you learned in chapter 3: objectivity, integrity, confidentiality, and the likes. Okay. Next one, plan and perform an audit with a professional skepticism. Means that you must have an attitude of what? Professional says that things might not be right as they have presented it. Okay. The next one, exercise professional judgment in planning and performing an audit. That can only be achieved over your experience, okay? Your years of experience will go a long way in achieving this, okay? Then next, obtain sufficient and appropriate audit evidence to allow him to obtain reasonable assurance. So what that means is that the auditor needs what? Reasonable level of assurance. That is, by obtaining sufficient and appropriate audit evidence, okay, that will provide him reasonable assurance about the financial statement. Then the audit, after you've done all of this, right? You need to develop what we call the audit planning memorandum. Okay. Before you develop the audit planning memorandum, let's explain what is an audit plan so that you have an understanding. Now, audit plan is a course of action, okay, decided in advance to achieve a stated goal or objective. All right. So it is a plan that is necessary for each audit so that the auditor can decide in advance what it needs to be done so that the required date of completion will not be what? Will not be extended. So like I said, an audit plan, audit strategy is just giving like an overall information about how the audit will go in terms of the planning decisions. But the audit plan goes in depth to analyzing how the auditor will achieve this audit strategy. How the auditor will achieve the audit approach is what we are talking about in audit plan. So you look at expenses. You have to have an audit plan for expenses. You have to have an audit plan for revenue. You have to have an audit plan for non-current assets. You need to have an audit plan for non-current assets. You need to have audit plan for liabilities. All of them like that. So you have to cascade things down granularly into each of those areas of the financial statement. That's why we call it an audit plan. Okay, because that's the only way you can achieve the essence or the objective of the audit. All right. Now, while the auditor is trying to develop his audit plan, he needs to consider these three areas. One, audit risk. Two, materiality. Three, the use he might make of computer. One, audit risk. Two, materiality. Three, the use he might make of computer. What that means is that is the client operating in a computer-based environment or is operating manually. Okay, so let's look at them one after the other. Okay, let's look at them one after the other. So, when the auditor is about to commence the audit, okay, of his client business, it's essential that he ensures that the audit is planned and performed in an efficient manner, like I have said earlier, okay? So, IS 300 states that an audit should be planned so that it is performed effectively. What that means is that you're able to achieve the audit objective. You say you're going to finish on so and so date, you completed it on the set date. There was no need for what? Extension. Two, the auditor should establish an overall audit strategy. I've dealt more about audit strategy in chapter 6, the chapter we just completed. Thirdly, the audit plan should include measures for the direction, supervision, and review of audit work. Remember in chapter 5, when we talk about practice management, we talked about having an engagement quality reviewer and also the engagement partner that ensures that every bit of that particular engagement is executed, right? So we have the audit strategy memorandum. So this is the document that contains all the planning decisions about the audit. It's called the audit strategy memorandum, or you call it audit planning memorandum. Either name is what you can add, you can call it. You can call it audit strategy memorandum or audit planning memorandum. Either of the name you apply, okay? So this document, like I said, contains all the planning decisions in an audit engagement, okay? So one, you have some of the information that is contained in it are one, the audit objective and report to be issued. Every audit has an objective and the nature of the report to be issued is always there. Two, the audit timetable to meet the required reporting deadlines for the audit. The audit timetable, audit has a timetable of how they want to carry out their activities in an engagement, in a given engagement, what are the things they want to do, how they want to go about it. They have a timetable. It's also contained in the audit planning memorandum. That is, in each engagement, you have an audit planning memorandum. I hope you understand. In each audit engagement, there is an audit planning memorandum. Not that you have a colossus of engagement. In each engagement, you must have an audit planning memorandum. All right. Thirdly, Thirdly, another information that is contained in that audit plan memorandum is change in the client's organization of business. If there's any change in the client's organization of business during the last year, since the last audit, for instance, as at the last year they audited them, the company was just had a branch in Nigeria, but now they have extended to neighboring countries, Ghana and Cote d'Ivoire. Okay, that is something that you need to also look into. All right. Then next, uh, summary of key financial issues. You know, that is what we call the analytical review procedures. Summary of each financial issue. How we call the analytical review procedures. So what that implies is that the ratio will give you insight into the performance of the organization. You need to analyze the company, whether the company is doing well or not. All right. The use to be made of the client staff. That is, you are going to talk about how do you intend to use the report from the internal auditors, if it exists? Okay, how do you intend to use their services or their report? Then, possible problem areas in the audit and the approach to be adopted to deal with them. So if there are areas in the audit, because you will have carried out what we call a preliminary audit risk assessment, you will have an understanding of potential areas of what problems, okay? Be able to afford how you are going to tackle them in the memorandum. All right? You put that in your what? In the memorandum. Then another one you need to also consider that's also included in the memorandum is the staffing requirement. How many of these staff do you require? Okay, you have your audit engagement team. How many of them would you require? And that will only be possible when you have done the preliminary audit risk assessment. Okay. Then attendant location also. That is, how many locations does your client have? That can only be possible if you have done your preliminary audit risk assessment. Give you an insight into how many staff that they have. Okay, how many locations that exist. Then next, method of communication. For method of communication, are you going to be using social media? You're going to be sending mails. You're going to be calling. That medium needs to be also be defined and established. Okay, so those are the things that some of the information that is contained in the audit planning memorandum. Okay, now to effectively plan your audit, right? You need to look at the you need to gain an understanding of the client business, how the client business operates. Okay. And one of the ways you can get to know how the client business operates, you look at certain documents from the clients. Number one, you need to look at if the company or your client has what? A loan agreement. You need to request for that loan agreement, understudy it, right? And try to ask questions around it so that you'll be you'll be confident that the information you are requesting from your client is or your is accurate. So you need to also review the legal correspondences between your client and his legal advisors, okay, on certain matters. For instance, if the company has gone into litigation before or has been involved in litigation before, you need to take hold of the correspondence document and check through it, okay, and check through it. Then, another thing you also need to focus your attention on. You need to look at the sales contract, okay? Revenue is one of the key areas of the business, right? You need to look at whether there exists some sales contract, whether implied or documented, okay? You need to look at it. So you need to look at it and be able to establish that this exists. Then you need to also request for copies of previous year's financial statements because you cannot talk about today if you have not looked at what has happened in the past, especially in audit. You have to look at prior years' financial statements, be able to determine where the company is now. Okay? Are we together? Then another thing you also need to look at is the Non-relevant information. Non-relevant information here, what does it mean? What it means here is that in the course of performing the audit, there are some information that you have gathered, but might not be required during the audit report. But you're going to use them. You are going to use them in subsequent engagement. For instance, you're going to carry out a review engagement of the client, or you're going to do what we call um, you're going to do what we call an assessment also. I'm coming. So what will be my non-relevant information is the fact that there's information that will not be required for that particular engagement, but for subsequent services you are going to render to the client. The other service you are render to the client. For instance, you are doing due diligence for the client. Some of those information you have gathered during the audit can become very useful. Okay. You are doing a review assessment or any form of other service you are rendering, you are going to use those information. So those information or that information, they are not useless. But what we are saying is that at that particular engagement, you don't need them for the audit of the financial statement. You use them for subsequent engagement. Okay. I hope that is clear. We go to the next one. Audit risk. You know, I said that there are 3 areas you're going to focus on when you are designing your audit plan. Audit risk, materiality, and the nature of the environment in which the client operates, whether it's computer-based or a manual system. Let's start with the first one, audit. What is audit risk? Audit risk is the risk that the auditor will give an inappropriate audit opinion. Audit risk is the risk that the auditor will give an inappropriate audit opinion. That is audit risk. Okay. So at all times, the potentialities are there. That is, there's always a potential that the auditor will give a wrong audit opinion about the organization. And the only way this can happen is if the auditor has not gained understanding of the client business. Where the auditor has not gained understanding of the client business, this is likely to occur. Okay. Now, in the audit risk, right, there are 3 things you need to look at. Right? There are things you need to look at. One, you need to look at inherent risk. 2, control risk. 3, detection risk. These 3 risks are very, very important when you're analyzing your what? Audit risk. Let's look at them. But the whole essence of audit risk is that at all times, you cannot eliminate audit risk, but you can reduce it to the what? To the lowest acceptably level. Lowest acceptably level. Okay? I hope you are getting it. So that is, are we together?
Yes, sir.
Okay. All right. So we are going to look at them one after the other. Inherent risk, control risk, and detection risk. So what is inherent risk? Inherent risks are risks that by their nature, they are susceptible to what? Manipulation. By their nature, they are what? They are susceptible to what? Manipulation. There are some transactions, there are account balances that by their nature, they are susceptible to what? Manipulation. Examples, non-current assets, current assets, and liabilities. How? Let me explain why. How they are susceptible to manipulation. You go back to your IS-36, that talks about impairment. What does this say? What does that standard say? IS-36 that at all times you try to what? Test your asset against what? Impairment. That is, your carrying amount should not be above or lower, so that will not be giving a wrong impression about the organization. Right? Now, if the organization has failed to carry out impairment test of the assets, what does that imply? That means whatever value they are putting as their non-current asset in a financial position is either higher or lower. And that will be what? Misleading. You understand? You go back to your current asset also, look at inventory. Inventory, if you go IS2, talks about what? Inventory. And IS2 says that for you to cost inventory, the only approved methods are first in, first out, or weighted average. Okay? First in, first out, or what? Or weighted average. Do you understand? First in, first out, or weighted average. So any other method outside these two, they are not allowed. But if the management has used other methods like last in, first out, standard costing, base stock, all those costing, they have used it to calculate their inventory. What does that mean? That means whatever value they are going to give in the financial statement could either be higher or what? Or lower. And that would be what? Misleading. The same thing is applicable to account receivables. There are instances where there is no account receivables, but the data has not carried out a test, okay, to be sure, to verify, to confirm that those account balances do exist. By requesting for the customer's list, customer's ledger, to vouch that those balances actually exist. And whatever value that is there will be what? Will be misleading. Okay? So that's why I said that by their nature, they are susceptible to what? Manipulation. Whether they are individually or they are aggregated, whether they are standing alone or they are added up or summed up, is what we call inherent risk. Control risk. What are control risk? Control risks are risks that exist as a result of the fact that the existing internal control system. Can you hear me?
Yes, we can just hear you now. Yes, now.
Okay, fine. There's a technical issue, that's why. Okay, I was explaining the three components of audit risk. Okay, I said audit risk is the risk that the auditor will give an inappropriate audit opinion. That is audit risk. And I said that the potentialities are always there, because if the auditor has not gained understanding of the client business, there's every possibility that he's going to give an inappropriate opinion about the organization. Okay? Then, at all times, the audit risk is always there. It should be what? Kept at a reasonably low level. It should be what? Kept very, very low. You cannot eliminate audit risk. It's always there, right? But it is the duty of the auditor to ensure that the audit risk is brought to an acceptably low level, because if the audit risk is high, the effect is that the audit opinion provided is incorrect. And should investors rely on that information in the audit report, it will affect the organization. It will affect the organization. And at the end of the day, the auditor will become what? Will become negligent, right? The auditor will become negligent. I know we have done chapter 4 that talks about auditors' professional negligence, right? It will result to something like that. So at all times, the auditor should ensure that this audit risk is brought to an acceptably low level. I've explained what inherent risk is. I said that it is a risk that by their nature, they are susceptible. That is, they are prone to what? Manipulation. Account balances, account transactions that are prone to manipulation is what we call inherent risk, whether individually or when summed together. All right? Then the second component of audit risk is what we call control risk. And these are risks that exist, okay, as a result of the fact that the existing internal control system put in place could not detect, okay, misstatement that would not detect misstatement or prevent misstated that are contained in the financial statement. You have put controls in place. You have put system in place to drive compliance, to ensure that they post correctly. But these controls you put in place is not achieving these controls, okay, this objective. We call it what? Control risk. Let me give an instance. So you said that your accounting policy, you said that any transaction above 1 million naira, okay, should be accompanied with a purchase order. Every procurement above 1 million naira should be accompanied with a purchase order. But you discover that for transactions over 1 million naira, that are about 20 or 30, none of them had a purchase order attached to them. Okay, none of them had what? Purchase orders attached to them. So what that implies is that you have put control in place, but that control is not achieving its objective. I hope that is clear. That is what we mean by control risk. The third one is called detection risk. Now, detection risk is the risk that is prone to the auditor himself. This one is the auditor's problem. And why did I call it auditor's problem? Because you cannot audit what you don't understand. So if the auditor has not gained understanding of how the client's system operates, right? All the tests, all the procedure is going to do will not achieve the objective. So detection risk is the risk that the auditor's tests and procedures on account balances and transactions will not achieve the audit objective. We call it what? Detection risk. The risk that the auditor, all the tests the auditor performs, all the procedures performed will not achieve the audit objective is known as what? Detection risk. Those are the three types of risk that makes up the what? The audit risk. I call them the elements of audit risk. So, of all these audit elements, the only one that is within the control of the auditor is the detection risk. The only one that is within the control of the auditor is what? Is the detection risk. So if the detection risk is high, right? So it will have an effect on the what? On the audit risk and vice versa, okay? So that is what we have been talking about since, okay? So now, what you need to understand here is this. There's a relationship between these three elements: inherent risk, control risk, and detection risk. Now, what's the relationship? Now, if the inherent risk and control risk are high, right? They go, both of them, they always go in the same direction. When inherent risk is high, control risk will also be high. As depicted in this picture, you can see. I hope you can see my screen. Can you see my screen?
Yes, sir.
Hello? You can see it's good. When the inherent risk is high, control risk will also be high, and vice versa. Okay? And when inherent risk and control risk are low, right? Detection risk will be what? Will be high. So detection risk goes in opposite direction of the what? Of the two. So when inherent risk and control risk are high, detection risk will be what? Will be low. Okay? I hope you are getting it. So when detection risk is low, let me give you the implication of it so you understand what I'm saying. So let me explain it to you. When I mean detection risk is high or low. Now, when detection risk is low, what that implies is that the auditor has gained understanding of the client business. He understands how the client business operates. So he understands it. So he's going to collect, he's going to carry out less audit tests. You understand? He collects what? Less audit tests. And he's going to also collect less sample size. That is if the detection risk is what? Is high. You understand what I'm saying? So what that means is this. When detection risk is high, let me explain it so that you understand it, because it's very, very dicey and very tricky. It means that the auditor has not understood the business. Do you understand? Are you with me? If you look at this diagram we have here, so that let me use the diagram to explain it so that will be better. Look at it. When detection risk is low, higher level of audit testing. So what that implies is that when it is low, it means that the auditor does not know. He does not understand how the business operates. That is if it is what? If it is low. And because it is low, for him to gain understanding, he needs to gather or carry out more tests for him to be able to have an understanding of how things are supposed to be done. And by doing so, you know, I said that audit, we don't test everything. We only test what? In samples, right? Later we collect a larger sample from the what? Population. Let's say population is 100, okay? Ordinarily, if he has an understanding of how the business operates, he might only collect 10%. of the population and use the result to conclude on the entire population. But in an instance where the population is 100%, is 100, right? But the auditor does not have an understanding of how the business operates. Instead of him to collect like 10% of the population, it will collect, or it will take over 30% or 40% of the population to be very sure that he has done the needful. Do you know what I'm saying now? So what that implies is that it's like saying that when you say something is low, means that it is of low quality. And when something is high, it's of high quality. So just use it as that to have that understanding. So you say the auditor has a low level of knowledge or low level of knowledge. You say that the detection risk will also be what? It will be what? Very, very low. So because of that, it's going to gather more audit testing and take out larger audit sample. But in the case where the detection risk is high, that means you understand the system, right? The audit procedure is going to carry out will be what? Will be very, very small. Okay, the sample size is going to take it will be very, very small, and also it will require less audit testing. It will not carry out a detailed audit because he has an understanding of how the business operates. So if you look at the relationship between inherent risk, control risk, and detection risk, that gives us what we call what? The audit risk model. The relationship or the model that shows the relationship between inherent risk, control risk, and detection risk is known as what? Audit risk model. I hope. Do I need to explain this again, or are we cleared?
So please go ahead.
Yeah, I can proceed, right?
Yes.
Next one, we just look at audit risk. Let's go to the, before I go on, before I proceed, let me also make some other contributions. Now, the audit risk, right? There are some other risks that are also important for the auditor to understand. And what are those risks? The first one is the business risk. The second one is the financial statement risk. And the third one is the audit risk. So there's a relationship between the financial statement risk, financial statement risk, business risk, and audit risk. I'm combining the three of them together, and I'll show you the relationship that exists between them. Okay? Now, what is business risk? Business risk is the risk that the company will not be able to achieve their objective. Those factors that prevent the company from achieving their set objectives are what we call business risk. Okay? I hope we are together. Now, what that implies is that this risk can either be internal or external. Internal, in the sense that they are within the control of the organization. Internal means they are within the control of the organization. Okay? So they are within the control of the organization. We call it what? Internal. Okay? Then external, they are the ones that are outside the control of the organization. But whichever, whether internal or external, the company should be able to manage its business risk. Okay? Now, in managing the business risk, whatever they are going to do, we have an effect on the financial statement. Whatever strategy they are trying to put in place to manage the business risk, we have an effect on the what? On the financial statement. Okay? So what does that imply? Let me give an instance. The company is a manufacturing concern. And remember, 2023, government increased the tariff on what? On sugar to prevent what? Importation. Okay? So what did they do? Why did they do it? Because they say that Nigerians, right? Many Nigerians are suffering from diabetics or diabetic. And then many Nigerians are suffering from what? Diabetics, right? So what that implies is that in a way to control diabetic amongst Nigerians, government increased the tariff on importation of what? Sugar. Now, for organizations like Coca-Cola or NBL, Nigerian Breweries, if they have to continue to import sugar, they should find a way to doctor their financial statement or to present their financial statement in such a way that they will make available, they will improvise on whatever is available to them for production. So for instance, they say they ban sugar, but we have polysaccharin that they use in place of sugar. We have dates that can be used in place of sugar. We have honey that can be used in place of sugar. And we have other sweeteners that can be used in place of sugar. But they said they have banned what? They've increased the ban on what? Importation of what? Sugar. So what that implies is that organizations will look, because if they put sugar, for instance, let's say they put sugar in their financial statement as a raw material, component of the raw material or active production ingredients, okay? Active production ingredients in the making of their product. They're going to list sugar there. FRS, when they are submitting their financial statement, is going to slam them heavily on what? On that contravention. So what will they do? They will use other sweeteners like polysaccharin, honey, date, and whatever. So as an auditor that does not understand this, what that implies is that that financial statement, there's a risk that they are put some information in that financial statement that poses or that will affect the decisions of the users of that financial statement, because they don't understand the financial statement, but the auditor is supposed to understand financial statement, and he also does not understand it, because the information that they have put in that financial statement, it wasn't carried along, and he didn't even know. So he has that risk is called the financial statement. That is, there are information in the financial statement that are unknown to the auditor, right? Because those information, one way or the other, they have misrepresented or misclassified the information you have in the financial statement. So we call it what? Financial statement risk. That is the risk that there are misstated information in the financial statement. Then we have the third one, which is called the audit risk. I've talked about audit risk. So when there's a business risk, it will lead to what we call a financial statement, because the client will not want to go past the body or to the final consumer. So they are going to in the financial statement. So when they put that information in the financial statement to hedge against any risk, right? We call it financial statement risk. So if the auditor is not able to detect it, it will lead to what we call audit risk. So that is the flow. It starts from business risk to financial statement risk to audit risk. I hope we are getting it. Is there any question, comment, observation? Hello, class. Are we all together?
Yes, we're together. Please go ahead.
So that is the relationship between the three of them. All right. So when they, if they understate the figures in financial statement to satisfy certain business objective, is classified as what? Financial statement risk. Okay, that is what I'm trying to explain. So that is that. So with that, I can proceed to the next area that I want to talk about, which is materiality. We say that there are three things you need to consider when you are carrying out what is called, you are drawing up your audit plan. The first one is audit risk, which I just finished explaining now. The second one is called materiality. Now, what is materiality? Materiality is contained in what? It's contained in ISA 320 that explains materiality. What does this say? An information is material if its omission or misstatement would influence the economic decisions of the users of the financial information. An information is said to be material if its omission or misstatement could influence the users of the what? Financial information. That's materiality. So if that information is omitted from the financial statement or it is misstated, thereby affecting the economic decisions of user financial statement, it is known as what? Materiality. Is that clear? Now, both audit plan and materiality, they are iterative. I take it again. Both audit plan and materiality, they are what? They are iterative. Iterative here means that they keep changing. It does not stop until when the audit is completed. That is, you can change, you keep changing your audit plan until when you completed the audit. It is not fixed. Your audit plan is not fixed. And your materiality too is not fixed. Until when you are done with your engagement, before these two will become fixed. Because you can set out to go a new dimension, a new direction. But when you are on the field, you saw something different. So you have to adjust your plan to suit what you met on the field. The same thing with your materiality. Okay? Now, there are two types of materiality. We have overall materiality and we have performance materiality. There are two types of materiality. We have overall materiality and you have performance materiality. Okay? What is overall materiality? Now, overall materiality is the materiality that has been designed by the auditor before the audit commences. I take it again. Overall materiality is the materiality that the auditor has determined before the audit what commences. Let me give an instance. The auditor wanted to audit an oil and gas company, right? So if it's auditing an oil and gas company, what are the things that he needs to consider? Some of the things the auditor will need to consider is to look at the nature of the what of the client business. Okay, the nature of the what of the client business. So in looking at the nature of the client business, one of the ways to understand the nature of the client business is to look at what the statement of, the financial statement. And by looking at the financial statement, you'll be able to see the revenue the organization has made in a year. You're able to see the total assets the company has made in a year. You're able to see the profit before interest and taxes for the business in a year. Now, by looking at this, you now design what your overall audit strategy is, because your overall audit strategy is based on three factors. You use either the revenue, or you use the profit before interest and taxes, or you use your total asset. Those are the three things you use to determine your overall materiality. And the essence of using materiality is the fact that you are trying to reduce the risk of material misstatement in the financial statement. You are trying to reduce the risk. You are trying to reduce the risk of material misstatement in the financial statement. So you are going to deploy this. So another thing you also need to know about overall materiality is that for you to be sure that there are no material misstatements in the financial statement, you need to have your estimated sample size that used to confirm that there are no material misstatements in this financial statement. You need to use what we call an estimated what? Sample size. Okay? What do I mean by estimated sample size? So you are going to an organization. Let's say the organization makes the revenue is over 1 billion in a year. That means your sample size for revenue. We look at the revenue ledger or sales ledger. You will say that, oh, so 1 billion, that is 9 zeros, right? So what is 1% of 1 billion? The 1% of 9 billion is what? I think it's 1 million, right? Somebody should please confirm. And somebody help me to confirm. Let me confirm myself. What's 1% of 1 billion? That's 10 million. Okay, 10 million is the 1% of 1 billion. Okay. So what it means here is that as an auditor, what you'll be focusing on, we'll be looking for transactions. What the auditor will be looking for is transactions that are above 10 million. Anything below 10 million for that organization that has 1 billion as their revenue is what? Immaterial or inconsequential. Do you have an understanding now? That organization that generates revenue of 1 billion naira in a year, when the auditor comes to audit, transactions that are less than 1%, that are less than 10 million naira, the auditor will not focus on it because they are inconsequential or they have no importance to the auditor. I hope we are getting it. That's why we say that materiality is what? Is subjective. So for another organization that makes 1 million naira in a year, right? That makes 1 million naira in a year. So that means for them, 1% of 1 million naira is what? 100,000 naira. So any transaction that is below 100,000, the auditor will not bother himself because they are what? Immaterial. So he's going to focus on transactions that are way above what? 100 million naira. Now, bear in mind that for him to be able to substantiate that it is material or not, you need to have an estimated sample size, okay, which I've talked about. They need to take as much as, let's say you say that for me to be sure that there are no material misstatements, right? As an organization, I need to obtain like 40 samples of transactions in the sales ledger that are above that amount. 10 million naira or 100,000 naira. And in looking at this, you now discover that from the sales ledger that was presented, there were no transactions that they couldn't provide up to 20 transactions that meet this requirement. That means that it is not what? Is not convinced. That means is not what? Is not convinced, because for you to be able to be convinced, because I said audit is what? Is scientific in nature. For the auditor to be convinced, he must obtain at least 40 samples, but he only got 20 out of 40. So he's not convinced. So how will he ensure that this is done? How will he ensure that this is done? What he will do is that he's going to review his materiality threshold. He's going to do what? He's going to review his materiality threshold. How will he review his materiality threshold? He's going to reduce that materiality threshold. Okay? He's going to reduce the materiality threshold to be able to accommodate for those samples that he requires. So now he uses 1% before, right? Now this time around, he might now say that for me to be able to get more than 40 samples, he will use, let's say, 0.1%. Okay? 0.1% of 1%. Rather than use 1% now. He has used 1%, he got what? 100,000 or 10 million respectively. But the required sample size he needed was not enough, was not adequate. So what will he do? He will reduce the what? The materiality threshold from 1% to 0.1%. By the time we reduce to 0.1%, what that implies is that 100,000, if we use 0.1%, will now be what? 10,000. And for that 10 million, it will become what? 1 million. So with that, we'll be able to gather as much samples as possible. That process of reducing the sample size, I mean the materiality threshold, okay, of reducing it to be able to have adequate information to substantiate that there are no material misstatements is what we call performance materiality. The act of reducing the overall materiality threshold to accommodate for the required sample size, or to be able to show that there are no risks of material misstatement in the financial statement being audited, is what we call performance materiality. Is that clear? Are we together? Are we together?
Yes, we are.
Okay. So that is what we mean by performance materiality and what we call overall materiality. Okay. So what other things you need to know about materiality? Another thing you need to know about materiality is that you can use revenue to determine your materiality. You can use profit before taxes. You can also use total assets. You can also use what? Total assets. Okay? To determine your what? Overall materiality. Any of them, we cannot combine them. You can only use one of them. Do you understand? You can only use one of them. I hope that is clear. So that's what you have here. So in determining your materiality, other things that the auditor will also need to consider will be the what? The nature of the item involved. The nature of the item involved. Okay? Now, there are some transactions, right? There are some transactions, right? They are very, very small, but they add a little bit of what? They provide a little bit of what? Contention for the what? For the auditor, because of their what? Subjective nature. Because of their what? Subjective nature. Example of some of these things are when you have issues like what? Provisions. Okay? Let's look at what? Provisions that have been made. Okay? Provisions that have been made for particular transactions. Okay? Provisions that have been made for particular what? Transactions. So sometimes the author will need to review it and say, how did you arrive at this provision? For instance, electricity. You make a provision that, tariffs has gone up. But before the tariff went up, especially for those that are on band A, they used to pay 70 naira before per kilowatt. Now they are paying 225 per kilowatt. So when they got wind that they are going to revise the rate, some organizations have made provision for it already. So when the auditor comes, they will need to explain to the auditor how they arrive at the provision. If the auditor is not clear, there might be need for them to review that provision, because provision is what? Sometimes can be what? Relative or subjective. Is that clear? Another thing that also needs to be considered when determining the materiality is the significance of the item. Okay? Significance of the item. For instance, directors' emolument is one area that is very, very important, especially for companies that are listed. Especially for companies that are what? Especially for companies that are what? That are listed. So people, the shareholders would like to know, or the people would like to know how they have paid those people, how they have paid the directors. How they have paid the what? The directors. Okay? So this information, remember, in 2016, 2017, thereabout, there was an issue about this thing with Orlando PLC, where they were sanctioned. Their stock was suspended on the Nigeria Stock Exchange and on the New York Stock Exchange because they paid dividend from unrealized profits. Go and check, go and Google it, go and find it, it's there. Their shares were put on technical suspension because of that, because you made losses, you have been making losses all this while. How were you able to pay dividend? Dividend is paid from what? From profit, but they paid dividend out of what? Losses. Somebody flagged it and reported to the regulators, and they were sanctioned. So you understand what I'm saying now? So the ignorance of the item can also be a what? A contributing factor. Okay? So that is that about materiality. Is that clear? Are we all together? Are we all together? Can we proceed? Is there any question? Is there any comment? Is there any observation?
I'm good, sir. No question from my end.
Okay. The next area we are looking at is what? Computer in auditing. You know, we said there are three things that need to be considered when you are doing up the audit plan. Audit risk, materiality, and what? Computer. Okay, the nature of the client business. That is computer-based or manual. And that takes us to computer in auditing. Okay? Computer in auditing, we are going to, if we start it now, I'm going to start it, but we won't be able to finish it today. So I'm going to focus on some areas or some aspect of it. So what that implies is that it's the nature of your client business that will determine whether you are going to use computer, okay, or not during the what? During the planning process, okay? So we are going to talk about the first aspect, which is what? Using computers to perform the audit.
Oh, go ahead. What are you even this thing? Sit down. I'm not going to wait for make a chop hungry. They order.
So what are the things that the auditor will need to do? The auditor will use the computer to perform the audit work. And also, the client account system can also be what? Be made available to the auditor. And why is the account system made available to the auditor? They don't want to check whether there are controls that have been put in place in the computer system or in the account system of the organization, whether those controls are effective or not effective. Then another thing that also, if the client has a computerized environment, the auditor can deploy the CAT, computer-assisted audit techniques, to carry out the audit. The auditor will deploy what? CAT, computer-assisted audit techniques, because it's going to make it faster. You're going to be looking at all of these subsequently, okay? So using computers to perform the audit, it is usual for members of an audit team to take laptops, okay, when they are going to audit their client. So the laptops can be used for the following tasks. One, audit administration and control. For example, preparing the timesheet, how long you are going to, that timesheet is a record that shows time that are spent on each task, okay? Then you are going to use the computer to design the what? The audit plan. How long is going to take for the organization to carry out the engagement. Thirdly, you are going to use your computer to prepare the what? Audit working papers or audit documentation. So most audit firms now, they have software that they use to prepare these audit working papers or audit documentation. and they are installed on the what? On the audit staff laptop. The auditor will also carry out analytical procedures by looking at what? By looking at the financial records of the what? Of the client. That is the comparing the last year, the previous year financial statement with the current year financial statement, computing what? Ratios, by analyzing using what? Ratios. Then they also use software to take samples from the client system. They have all the software that takes samples from the client system, okay? So all of these are what are some of the things that you can use the computer to do, okay? Now, one thing we also need to note is that we have controls over the auditor's computer system, okay? So what that in place is that there is need to exercise control over the auditor's computer system, that is the auditor's laptop. The controls should be in place, that those controls in the computer system should exist because client's data are confidential and they cannot be what? They shouldn't be accessed by unauthorized person. That means there should be what? Password on the client, on the audit staff laptops. They must use what? Password. Okay? 2, they must save information there in a secondary offsite location. In case the laptop crashes, client information will not be lost. 3, audit trail is also created for the work of the auditor he has done. So what that implies is that for every transaction you do on the client engagement, there is a back end that tracks it. And that back end that tracks it on the laptop is called what? Audit trail. Okay? Are we together? Then the program operates in a way that can be what? Expected to do. That is all the audit programs, all the software that they have installed on the laptops, they are working as intended. That is, they are updated and they are what? They are functional. All right? They are updated and they are what? They are functional. So these controls that we are just talking about now, right? They are divided into 2. We have general controls and we have what? Application controls. We have general controls and we have what? Application controls. So we are going to stop here for today. We'll continue from there next time. Okay? But does anybody have any question, comments, observation? Are there questions?
Good morning, sir. Ogadi.
Morning. Morning, sir. I can hear you.
Sorry, please. I was on duty. The statement I made before earlier, they let me find place, sit down, eat, and it's just for my colleague, not for the group, please. I'm sorry for that. I didn't know I was on mute.
It's clear. No problem. I understand. We all understand.
Take care, Beck.
All right. All right. Any other question? Comment? Observation?